So it seems to me the beginning of 2024 has been a time of augmented cognitive dissonance, at least in the real estate community, because we have the Fed saying how great everything is and soft landing and gosh, isn't it just great to be alive in a time like this when everything's perfect? And yet in the real estate industry, we certainly have some issues. And depending on who you talk to, either this is the beginning of the end or this is the beginning of a brave new world.
You are listening to the AFIRE podcast, real estate, technology, cross-border investing, and the opportunities of a changing world. Let's start a conversation now.
So again, it's very difficult to hold on to all of that in your head. And that's why I wanted to take this podcast, and we're talking here at the end of March in 2024 with Mark Zandi, who's the chief economist at Moody's. And he was a speaker at our February meeting and actually gave us some hope for the future. So I figured I'd get another dosage of hope here by asking Mark to join us once again. So Mark, thank you for joining me on the AFIRE podcast.
Gunnar, it's great to be with you. Thanks for the opportunity. And cognitive dissonance, I haven't heard that since Marketing 101 at Wharton back in the day. But that is a very good way to describe things. In a lot of respects, not just commercial real estate, CRE, but a lot of different cross currents out there.
Even at Wharton, make it very clear that cognitive dissonance is not something that people enjoy having, that it forces us into some sort of motion, either to go with one side or the other, and where it goes. And I'd say probably the gestalt in real estate has been, we've got a lot of office vacancy. We've got what we're assuming is a kind of 40% average decline across the board in terms of office properties. That may be too much, too little. I don't know, because there's no transactions, but there is this discomfort, certainly. And we have, I don't know, a little shy of $1 trillion in commercial mortgages coming due this year. So in a high interest rate environment, there's a lot of concern, and there's concern that this will perhaps be too much for the overall economy, that this is going to, again, be the beginning of the end. Why do you think that might not be true?
Well, I mean, everything you said is correct. And just to be able to hold the two things in your mind at the same time, the economy is actually doing well. I mean, just take a look at all the jobs that are being created. The average monthly job growth is 250K, which is well above what anyone would have expected, at this point in the business cycle with the economy at full employment. And we are at full
Right.
employment. The unemployment rate's sub 4%. Inflation's coming in, the Fed's about ready to cut interest rates. So, from a macro economic perspective, it all feels pretty good. But you're right. In terms of the commercial real estate market, there's a lot of other dynamics that are playing out that, are quite problematic. And you picked on office for good reason. Obviously, remote work has done a lot of damage to demand. By the way, even if there hadn't been remote work, ultimately because of demographics, job growth will slow to the point where that will be a weight on absorption of office space. So that was going to happen regardless. But you throw into the mix the remote work dynamics, and it makes life very difficult. And I don't want to be Pollyannish. Clearly what's going on in the commercial real estate market is problematic and is a risk, and certainly is going to put a lot of pressure on the financial system. Anybody who holds those mortgages is going to have a lot of indigestion trying to digest all of this. But my sense is that we're just not going to see the kind of defaults and delinquencies and defaults and stress that would be sufficient to push the economy under. It would have to run through the banking system most likely, and the banks are, the big guys in particular are pretty good shape. Their exposure is, manageable. If you look at the SIFI banks as systemically important financial institutions and look at their commercial real estate holdings as a share of their assets, and that's all in. That's CRE mortgages, that's commercial mortgage-backed securities, that's loans made to real estate companies, REITs, and the like. It's 5-10% of their asset base, something like that. And then the big guys also take these so-called stress tests every year. They just took one a couple 3 weeks ago, the so-called CCAR stress test, and they have to stress their balance sheet to a 40% peak to trough decline in all CRE, not just office,
Right.
but the whole shoot and match, retail, industrial, everything. So it feels like they're prepared. I don't see those guys getting into trouble. Smaller guys, yeah, there's going to be some bank failures. I'm sure they're up to their eyeballs in CRE debt and not well prepared, but they're too small to make a difference. Now, one caveat going back to not being Pollyannish, I am assuming that, if you see a number of small bank failures, say, when I say small, assets of 10, 20, 30, 40, 50 billion, that's not going to spook people to the degree that we see another run on deposits like we did back a year ago. I'm assuming that that's an assumption, and I could be wrong, but in all likelihood, the banking system should be able to navigate through this reasonably well, and as such, associated to the economy.
So you are expecting that potentially we'll see some bank failures, but you don't think they're going to be big enough to move the needle significantly.
Yeah, exactly. Because I said the big guys, their CRE holdings are 5, 10% of their asset base. For the smaller guys, it's much higher, 25, 30. And there's some banks that are 50, 60, 75% of their asset base is in CRE. And of course, they don't take the stress test. I mean, if you're below, 100 billion, you don't have those kind of regulatory oversight. You don't have that kind of capital. So I wouldn't be surprised if we see a rash of small bank failures at some point over the next couple 3 years as the banking system tries to roll over the $1 trillion in debt that you just mentioned.
And now the question that always comes up as well, and there's no real definitive answer on this until it happens, but the Fed, when they met, they didn't seem that enthusiastic. Well, they certainly didn't cut interest rates at that point. They didn't raise them either. And we saw a slight uptick. I mean, it's not meaningful. It's still within that 3 to 4% inflation rate over the last couple of months. But where do you see this coming? Where do you see perhaps a softening of interest rates in the future?
Soon, and that's another reason to be a little bit more comfortable about what's going on in the commercial real estate market in terms of its macroeconomic implications, because we've probably seen the peak in interest rates. Long-term yields have come in. Instead of a 5% 10-year yield, we're now at a 4% 10-year yield. And I do expect the Fed to start cutting interest rates here by June. I'd be surprised if we don't get a cut, quarter point, and probably, if everything kind of roughly sticks to script, a quarter point each quarter going forward. Slow descent in interest rates, and that should take some pressure off over time. The broader economy and the commercial real estate market more specifically. The Fed has said that they want just a bit more evidence that inflation is going back to their target, their 2% target. They don't need to. We don't need to be at the target, but they need to be very confident, highly confident, extremely confident that that's where we're headed.
Right.
And I think they'll get the numbers that they need to get there by June. So I expect a June rate cut, and then couple more this year, and then of course, quarter point each quarter going forward.
So, what do you watch to ascertain if we're still on target for a June rate cut? I mean, what are the sorts of things that perhaps we can use as an indicator that, well, Mark is right, June is when it's going to happen?
Well, I think we're down to brass tacks here. It's the inflation statistics.
Hmm.
It's consumer price inflation, CPI inflation, and it's their target is based on another measure. It's called the consumer expenditure deflator, and they focus on the core PCE deflator. That's excluding food and energy. Economists do that just because the food and energy prices are very volatile, and if you want to get to the underlying trend, you just have to tease them out, just to exclude them. So the core PCE deflator has to be 2%. That's their target.
Right.
Right now, it feels like, after you abstract from the vagaries of the data, there's all kinds of, month-to-month seasonal adjustment issues, measurement issues. It feels like it's around 2.5%. So we're, as I would say, within spitting distance of the Fed's target. And actually, the only real difference that exists between 2.5 and 2 is the growth in the cost of housing services, particularly for home ownership. So if you own your own home, the way the inflation is calculated is your Bureau of Labor Statistics, the keeper of the data, calculates the implicit rent you would pay if you were a renter of your home. And so that's a very problematic, as you can imagine. Think about that for a second.
Yeah.
That's very difficult to measure, but that's what they do. And right now, that remains elevated, and that reflects the very significant increase in rents that occurred back, a year or two ago when the economy reopened after the pandemic and all these households formed. And the supply side of the multifamily market was kind of bottled up because of the pandemic-related supply chain issues and labor market issues. But more recently, demand has softened because rents are way up, and supply is now coming into the market because the supply chain issues, labor market issues have been resolved. In fact, we're seeing a close to record number of multifamily units getting completed right now. So that should keep rents down, and that should translate through, and we should get a slowdown in the growth of the cost of housing services, which will close that gap, that 2.5 to 2%. So feels like we're already there. If I were at the Fed, I'd be arguing, let's cut rates now. But the preponderance of the view there is let's just wait a few more months and get the evidence that we need, and then we'll cut.
Well, that certainly is more optimistic than what I've heard from some folks expecting the rate cuts to not happen until the third or fourth quarter. So this is, I think, very
Well,
good news.
you're hanging around the wrong people,
I
Gunnar.
am. I am. I'm hanging around a
Yeah.
bunch of morose people. It's not good. It's not good enough.
They could be right. Obviously a lot of uncertainty here, but I think the most likely scenario is probably June.
So again, we've talked a little bit about the banking and the problems that people are having certainly in their real estate portfolios that we're working through, and I think it's more than simply just a kind of a capital restructuring because of higher interest rates. We've had a lot of long-term issues, especially in the office sector, that we need to work through, and it's going to take us some time. We can talk endlessly about that, but I'm much more interested in where are you seeing the growth? Where are you seeing the excitement? I think a lot of our investors are saying, "All right, so how do I invest into what's happening with tech or what's happening in AI? Where are the bright spots at this point?"
Well, you mentioned technology. AI is like the hot thing, right? It's a little bit difficult to gauge just what's sizzle and what's real. But every company on the planet is fully engaged in trying to figure out if they can, and how to utilize artificial intelligence, more effectively in their business practices. And we're at the early stages of that, so we're off and running there. I think there's a lot going on in almost every sector of the economy. Feels like there's something percolating, something generating new interest in economic activity, from healthcare to educational services to financial services to professional services. The economy just feels quite dynamic. The really, it's easier to focus on the things that aren't going well, or struggling a bit, and it's understandable given the high rate environment. Manufacturing is struggling. So global trade has been kind of flattish. The Chinese economy has been struggling. They're key to all of that. We've seen some softness in commercial real estate, as we discussed, some weakness in trade and transportation. But outside of that, it feels like the economy is doing just fine. We're seeing growth across the board. But obviously, the thing that's kind of capturing the imagination and clearly the stock market is what's going on with AI. And I think it's real in the sense that it is going to result in some significant improvements in business practices and in productivity growth. But we're probably getting overly excited about how quickly that's all going to happen. It feels like that's going to take some time. If you look at previous technologies that were kind of game changing, like the internet, for example, or wireless, or even electricity, it was only really when new businesses formed and optimized around the new technology that things really changed. And I suspect that's going to be the case with AI. Legacy companies like a Moody's, it's harder, but just because you got to change the way you're organized, you got to hire new people, you got to invest in new equipment and software, and you got to reorient things, and that's you got to do it, but it's tough to do. For a new company, you're there.
But my concern is when we talk about, and everyone is excited about AI. You're right. It's just like it's frothy. Is that it does in the past when we've had technology kind of hype cycles like this? There's always a dip that occurs as well as people kind of realize, ooh, wow, I've got a few years and a lot of money before this thing starts paying off. Do you anticipate that we will see at least some leveling off of this excitement this year?
Yeah, I'd be surprised if we don't, right? You're right. The euphoria takes hold, drives up asset prices. Stock prices have gone skyward here, particularly for the so-called Magnificent Seven that are, benefiting most directly, most immediately from the advent of AI. But yeah, you're right. I think once people realize this isn't a game changer tomorrow or next month or even next quarter, maybe even not next year, then there's going to be some reevaluation of the values that they've attached to these companies, and we'll see some pullback. And just the equity market broadly feels a bit pricey by any measure, even excluding the Magnificent Seven at this point, because the rest of the market has also rallied. I wouldn't say it's screamingly overvalued, and it doesn't feel speculative. It's not like people are, buying simply because prices have risen and they think they can, sell at a higher price to someone else, get out, quicker than everybody else. I don't think that's what's going on. So I think if you told me there's going to be a 10% correction in price, I'd say, okay, that sounds about right to me at some point over the next year or so. I wouldn't be surprised. But I think broadly, the market is on pretty good fundamental underpinnings. Businesses are doing well, profits are high, corporate earnings are strong, and if interest rates do decline, then that's another plus. So I do think the equity market should kind of hold firm here.
And we also have Bitcoin, I guess.
And
Again,
then we have Bitcoin. If you really want to speculate, take your chances. There's always Bitcoin.
It's amazing to me how often we seem to be going through these Bitcoin cycles, and it's somewhat disturbing about human nature, I think, to a certain extent as well. I frankly don't understand why we're spending so much energy to mine for Bitcoin. It's like you couldn't invent a dumber thing for us to do as a people. It's
Right.
just ridiculous.
Right.
Here,
Totally.
here we
Yeah.
are trying to figure out how to
Yeah.
transition our energy grid, and at the same time we're increasing the amount of energy we're using for people to solve puzzles so they can get Bitcoin.
It is bizarre, isn't it?
It's just
Yeah.
it's frightening.
Yet, my son keeps bragging about the value of his Ethereum.
Oh,
so
God. Yeah, well, So a lot of the conversation, certainly in real estate, really, this is a new conversation for us. It shouldn't be, but it is newer, is how much geopolitical concerns are part of our conversation right now. In terms of, so China is having trouble at this point, and we have more animosity and a more kind of mean language between China and the United States. We also have certainly two significant conflicts on the other side of the Atlantic. What are you looking for that might interrupt this lovely kind of even growing economy? What are the warnings that you're looking for, or the warning signs?
Well, it's interesting when I talk to groups, and I think even the AFIRE, when I spoke to the AFIRE group, as I recall, I start with asking the audience what they're worried about, just to get a gauge of the audience and to engage them. And I think the first concern expressed was in fact global uncertainty, the so-called geopolitical risk.
Mm-hmm.
And I think this was the AFIRE conference. I asked the person who said geopolitical risk will, can you be more specific? And he said, pick one. So I think that is a general concern, but I would say the fact that people are focused on geopolitical risks makes me even more confident that we're in a pretty good spot because, generally, and if things aren't going well, people can come up with real concrete, I'm worried about this. And it's much more here at home. When they're saying something amorphous about geopolitical risk, it feels like they're kind of searching, struggling for, what could do us in. Certainly these things could,
Yeah.
but
Yeah.
the other thing I'd say is, there's always geopolitical risk. I don't know about you, but I'm older than you are. But when I was a kid in elementary school, we'd have drills where we'd run under our desk because there was going to be a nuclear bomb. That's geopolitical risk, not this. So
yeah, no, I mean,
yeah.
we've seen it before.
Yeah.
I think part of what was
Yeah.
interesting to me when I asked the question of our membership in one of our surveys, if they had a different strategy, investment strategy based on the changes in the election year. If,
Okay.
depending on who was in charge, both here and outside the US. And the majority of them said no.
Yeah.
That yes,
Right.
they're worried, but I don't think people are creating different strategies based on what direction certain things go.
It's almost because you just don't know how they're going to go. I
Right.
mean, how do you plan? I mean, I do think if I had to pick a geopolitical risk, quote unquote, I'm worried about, it's the one you just pointed out. It's the election.
Yeah.
And we've got a boatload of elections all around the world,
Right.
but the U.S. election is probably, clearly is the most important. And I think we can say with confidence that it's going to be close. And if it's close, it's likely to be contested in the current environment. And so I think everyone should kind of be prepared to buckle in here. There'll be a fair amount of volatility.
Mhm.
And that doesn't augur well on the other side of the election, regardless of who wins.
Right.
We've got a very large national debt load. The nation's debt to GDP ratio is 100% and rising pretty quickly, and all the trend lines look pretty ugly. So I do think that's a very large challenge. But I don't view that as a kind of a dagger in the heart of the economy this year or next year. That's one of those things that's more like a corrosive on the economy until it eats away at the legs of the stool, and then we at some point we break. But I think that's a number of years, maybe even a number of decades down the road if we don't change things.
Now, another risk that I think has risen in importance within the real estate investment community is environmental risk, and specifically the effects of global climate change. When I asked a year ago if anyone in our organization, in our collective group, felt that climate risk was priced into the current real estate
Mm,
markets, a very clear majority said no. We are not
mm,
pricing for it. And fast forward another 18 months, and we now are in an environment where insurance companies are starting to double, and in some cases even triple insurance premiums or deny insurance, which certainly really brings a full stop to real estate investing at that point. The climate risk is now being priced, or at least there's an attempt to price what that risk is because it's still uncertain. We're in uncharted territory. How do you see that playing out, not just in the long term? That's one discussion, but on the near term, I mean, how do you see people adjusting, given perhaps more storm damage or costs related to drought, fire, et cetera, across the U.S.?
yeah, it's interesting you bring that up because I've been, I do a lot of house price modeling prices across the country. And up until very recently, I could not tease out of the modeling the impact of the cost of climate, insurance costs. Obviously, a lot of things going on in the single family housing market that make it difficult to tease out something that's more on the margin. But more recently, you are starting to actually see it show up in the data. And the most vivid example of that is in Florida. If
Hmm.
you go to the southwest part of Florida, because they got crushed by that hurricane not so long ago, and insurance rates have gone up, and getting insurance is in many cases very difficult or not possible for many commercial real estate developers. So they're self-insuring. So it is starting to show up, and I do expect that it will become over time, more evident in pricing. To some degree, that's how this has got to work,
Yeah.
right? I mean, otherwise, people are going to build where they shouldn't be building, and this is a way to get them to move and to build where it's safer. So I think this is a cost that is now in our face and going to continue to rise going forward. It's not something that can undermine the economy, though, in the near term. That's not the issue. It's one of these cost that's going to be again another corrosive
Right.
on businesses and on the real estate market, and particularly in places where climate is a real issue. Florida being a great case in point, California being the other. Increasingly we'll see it in different parts of the country, but it is finally starting to show up in the data.
It does seem like it's forcing a very rational conversation and less of a general worrying about what climate change means, but more of a okay, we have to do something about it in terms of how we invest. And it doesn't mean you're not going to have South Florida anymore. It means it's more expensive, and you just have to
Yeah.
understand what the risk actually is as you go forward with that. Are there risks in your mind that you think people are overlooking, that they're just not thinking enough about, and they need to?
No, I mean, there's things, but everyone's thinking about them. It's like, and maybe I'll point a few things in the financial system which I, watch very carefully that make me nervous, that bother me. But again, people, it's not like I'm alone in focusing on these things. There are, folks that are. But I worry about the growth in the non-bank part of the financial system. We're all focused on the banking system, but the non-bank part of the system has been growing very rapidly. So, for example, again, in the single-family housing market, non-bank mortgage lenders, these are smaller institutions, small balance sheets that have kind of entered in as the big banks have exited out in the post-financial crisis world for lots of different reasons. And they fund themselves with these warehouse lines in many cases with the big financial institutions. And I could easily see they get cut off in a kind of a risk off environment. And if they can't get the funding, then they can't make mortgages. And they count for, I'm making up the number, but 75, 80, 85% of all FHA, Fannie, Freddie mortgage loans out there.
Okay.
And that would be, obviously very hard on the housing market, which would reverberate around the economy. Also, just now you got me on the couch. I do worry about, and this is an area where people probably should be more focused. Liquidity in the fixed income markets, liquidity in the treasury market, the corporate bond market. What's happened is historically the trading in that market has been dominated by these large broker dealers, which are big parts of big commercial banks. They kind of match the seller and the buyer, but those broker dealers have not expanded out their balance sheet at the same rate as the growth in the amount of debt outstanding. So we've seen this explosion in treasury debt because of our large deficits and debt load. but the broker dealers have not kept up. And that goes to capital rules and other changes in regulation that just doesn't make it economic for them to do so. So the market is much less liquid. If something goes wrong, you could easily see the market freeze up and you don't get the trading. And if that's the case in the treasury market or the corporate bond market, that could be a big deal. In the treasury market, maybe the Fed could step in and provide liquidity if they needed to. They could just start buying bonds.
Right.
But in the corporate debt market, they could do that. They could set up a credit facility to do it, but it's just much more difficult to do. So I guess broadly, to answer your question, most things that I'm worried about, there's other people worried about it. But if there's one thing I had to pick where I wish we were all focused a little bit more on it as an issue and thinking about how to solve it, and it's in the plumbing, so people don't pay attention, but it's usually the plumbing that kills you. It's something out there that no one's anticipating.
Right.
It's in the plumbing, but that plumbing feels pretty rickety to me, and I worry about it.
And do you anticipate what will cause us to fix that plumbing? Is it going to be crisis that's going to focus, or is there any hope that we're going to do it without a crisis?
Well, there's hope because, again, as I said, I'm not the only one focused on this. Like the Treasury, if you go talk to Janet Yellen, the Secretary of Treasury, she'll say, okay, yes. Or go talk to the SEC and they'll say, yeah, I hear you. So they are trying to put more trading on clearinghouse through clearinghouses as opposed to kind of bespoke between broker dealers,
Right.
going through a centralized clearinghouse. And they're working at that. And I think that may help solve the problem, but they may not be able to get that done in a significant enough way, fast enough to forestall. And the liquidity in a market, as you know, can go from fine to not fine, like within half an hour.
Right.
So
Right.
it's like, and especially in the treasury market now, because believe it or not, as the Fed has started to exit out with its quantitative tightening, and because banks have kind of pulled back because last year with their security holdings, the value of the security holdings, hedge funds have come into the market and they're now much larger players in that market. And of course, as you know, hedge funds, they're there when times are good and they're not there when times are bad, and they move very fast. And so that, again, just adds to my angst.
Right. I can see that. At the same time, whenever we have these kinds of periods where there's not a lot of debt availability, certainly in real estate, and this has happened through multiple cycles, is where we start restructuring where the debt is going to come from. And it seems to be happening now as well, as a lot of institutions are really kind of going all in on creating debt funds. They're seeing as an opportunity to come into a market that perhaps they weren't able to come into before, and they are reasonably competitive. But that also, I think, raises some concerns. It is a somewhat unregulated part of the market, but we've done this before. We've done this multiple times. It feels like we might be creating the new debt market, although it's always a mess at the beginning.
Yeah, it's a great point. That is a great point. The only thing I'd say is the CEO of a major credit card bank once told me if it's growing like a weed, good chance it's a weed. So just saying, let's watch that carefully. It doesn't necessarily mean it's a weed. I'm just saying you should go look though. We should all be looking carefully.
The weed is in the eye of the beholder to a certain extent as well.
Yeah.
Weed-like growth of Kentucky bluegrass is something that people seem to like, but there are other weeds we don't like. You talked a lot 2 months ago about feeling like there is tremendous upside as well, and I think some of the investors that I talked to over the last quarter or so are kind of growing sotto voce a conviction that 24 will be an excellent vintage year for them to invest in. And that tends to be how they think. Where is the time to come in? Is that something you might agree with?
Yeah, I mean, obviously, it depends on your horizon. If you have a long enough horizon to get beyond what will certainly be some bumps over the next 6, 12, 18 months. But yeah, longer run, yeah, for sure. And you're right. For the past number of years, it felt like all the risks were to the downside. But now there's some risks to the upside. In fact, last year, 2023, was a excellent year. Turned out to be, not only did we not suffer a recession last year, but it was actually a really good year. The economy grew very strongly, 2.5% real GDP, and that goes to very strong growth in labor productivity. Labor productivity growth did pick up, and it has nothing to do with AI. There's a lot of debate as to what's going on and whether it's just temporary, but it happened, and it feels like it's continuing on into 2024. And the other thing is labor force growth. The increase in immigration, while creating a host of challenges for communities across the country, clearly. The one clear benefit of it is creating a lot of additional labor supply, which is helping to support all this job growth and growth more generally without inflation.
Hmm.
It's taking the pressure off the labor market and inflation. So you're getting a lot more growth than one would have thought. And that could continue to be the case. I mean, I do expect immigration to kind of moderate as policymakers get a grip on what's going on, but it should remain quite elevated. And if we were rational as a nation and had immigration reform and adopted an immigration policy similar to like Canada, then that would be the best, most effective, efficient way to raise economic growth and also address our long-term fiscal problems. Because if you get more growth and most of the immigrants are young people, that's going to go a long way to helping address our fiscal situation without having to raise taxes or pare back spending.
Well, Mark, you get to talk to a lot of the folks that are involved in policy. How do you make the case to policymakers that immigration is a good thing and not quite the dystopian nightmare that politicians quite often portray immigration to be?
Well, I think and I think people are coming around to this, lawmakers are coming around to this. We got to separate what's going on at the border with immigration. What's going on at the border, in my view, is a national security problem. We got to nail that down. And until we nail that down, we're never going to get rational immigration policy. They can't focus on allowing more immigrants in the country if the border is wide open. So we've got to nail that down. And we can't do that. Come on. We should be able to do that, get it together and do that. And once we got that nailed down, refocus on immigration policy. And now we came pretty close back at Gunnar in 2013. The Senate actually passed a great reform bill.
Yeah.
Got bogged down in the House. Now we have a great case study in Canada. They've done a marvelous job. And their economy would be in recession if not for all the high skilled, educated immigrants that are coming into that country. And that's going to drive a lot of growth. They're going to be a faster growing economy than ours in the long run because they've got a rational immigration policy. And if we just look at what they did and adopt something similar with our own American twist, I think we'd be in a pretty good spot. So the key here, I think, is we got to separate what's going on at the border with immigration reform more broadly.
Certainly, there's nothing easy about immigration. Even the Canadians have not had an easy go of it all the way through, but the outcome has been fantastic.
Oh yeah, there's a lot of adjustment, right? I mean, they got housing issues and affordability, and there's all kinds of issues. But at the end of the day, there's no better way to get our economy growing more quickly and address our long-term fiscal problems.
And certainly that's been a big part of a 250-year history of our own country.
Yeah.
And it's astonishing to me that we see this in black and white as opposed to understanding this is growth pains. These are difficult things that we have to work through, figure out the most rational way to do it. But it seems to be a political third rail sometimes.
Hey, if you run for president, let me know. I'm there. I'll be your economic advisor.
Oh boy, yeah. I don't think I'm old enough to be president. I'm only 60. I don't have the appropriate amount of years on me in order to.
You need to season a little bit.
I had to season. I've got another couple decades before I'm eligible. But no, and I think it's interesting that we're talking a lot more about politics now than I do remember speaking about politics in real estate circles for a long time, and not just because of what the Fed is doing, which is our usual kind of conversation, but about things that are usually seen as social issues, but they're certainly economic issues, and they're driving
you make
what
a good
happens.
Point.
It's like we're all having to become poli-sci majors again. I don't know why, but that's where we are at this point.
I'm good with that. I'm okay. I'm okay with that. I kind of enjoy it.
Yeah, absolutely. Well, there's a lot more storytelling there. You don't have just charts.
Yeah.
You can
there you go. That must be what it is.
You can talk about it a little bit more.
Yeah.
What do you hope is going to happen over the next 6 months to a year? What are the things that you think, gosh, if this happens, then it gets really interesting? What do you hope will happen?
Maybe the election turns out more graceful than I'm anticipating. And we get to a place on the other side of it, say this time next year, because we have a debt limit increase we've got to pass. We've got the Trump tax cuts for high-income households that will expire at the end of 25. We've got, I think, some Obama care health subsidies, tax subsidies that will expire. So there's a lot of things that both Democrats and Republicans are worried about and need to address. So it feels like we've got a period where we're going to have to come together, and I'm hopeful that we can come together and do some things that put us on a more sustainable path. And I don't know that it takes a whole. It's probably not as daunting as we think. I think we make some adjustments here and there. We should be in a pretty good spot. And I think I used this quote at the conference, but I'll do it again. This is the Winston Churchill quote that said, and I'm botching it, but you know what I'm going to get it roughly right. That Americans try everything and then ultimately do the right thing. And I feel like we're in the period of we're trying everything. So maybe this time next year we do the right thing, So I think I again, I don't want to be too Pollyannish, but I kind of think that there's a window could open here and some good things. And this shows my stripes a little bit, but I actually think the policy that was passed in the last couple of years, a few years, have been pretty good. I mean, the infrastructure legislation, that's a big deal. The CHIPS Act, I view that as national security, and look what it's doing to, we're building a lot of facilities here in the U.S. And even I know there's a lot of controversy over climate, but, good risk management say, okay, maybe we got all the climate warriors or got it all wrong, but let's hedge our bets here. And by the way, the side effect of all of it is we get off of fossil fuel, which is right now, even though we produce a lot of oil, we're still dependent on the Saudis for oil and Russians for oil production. Who wants that? So let's just do this. So I view policy as done pretty good, over the last few years. And I don't like the big deficits in debt. I obviously don't like that, but I think we've done some good things here, and I think we can do some more good things on the other side of the election.
Part of what I found interesting about your talk and the reaction that people had a couple of months ago is, and you weren't the only speaker that helped with this, is that it feels like one of the things we need to do this year and that we need to focus on is reducing the intensity of the drama. That it's almost like, I mean, nothing's perfect. We're in an environment where there's challenges, where there's problems, where there's this, but it's not necessarily, let's scream and run for the hills, which is where a lot of the rhetoric has been, not just politically, but I think just generally people have been kind of in a heightened state of anxiety, and it seems to be working against us. So one of the things I really appreciated from your comments was more of a sense of, it's hard, there's challenges, but it's not the end of the world yet. I mean, maybe we have an opportunity to do that later, but that doesn't seem to be what's happening right now. Do you still feel that way?
I mean, obviously we've been through a lot as a nation and as a world. I mean, I think the pandemic really put us through the ringer. I mean, in lots of different ways, and we're still feeling the ill effects of that. There are a lot of geopolitical risks that are scary. I mean, with the Russians fighting the Ukrainians, and Russia is a nuclear powerhouse. I mean, something to worry about. And what's going on with Iran and Hamas and the tensions with China and North Korea. So there are, I can see it. I do think it is amplified by the fact that we're all streaming media all the time. And, back in the day, going back to my grade school years, you had 3 channels. You listened to Walter Cronkite or the other 2 guys or whoever they were.
Yeah.
And there wasn't after that. And then maybe you got a newspaper in the morning. Some people got the newspaper at night, but it wasn't like constant bombardment. And you're not even sure what's real, what's not real, so forth and so on.
And my memory is Walter Cronkite didn't yell at us. He kind of calmed us down a little bit.
He calmed us down,
and helped us kind of, get a little bit more reasonable.
As opposed to the strategy today, right?
Absolutely. And I keep hoping that people will vibrate more to people that are saying, hey, let's just calm down. Let's kind of look at this and let's be serious about it, but let's calm down a little bit.
Yeah, I think, I do think I am an economist and everything feels like the economy to me, inappropriately so. But if we can maintain 4% unemployment, and we've done that for 2 years plus, if we can maintain it, and we can if I'm right and we get inflation back to target and we stay there for a while, I think then people over time are going to say, okay, I'm fine. I'm going to be able to navigate through and it'll be okay. Particularly if the Fed lowers interest rates, I do think lower income households are definitely struggling. They did take on a lot of credit card and debt, consumer finance loans, and they're paying a lot on that debt now because of the high rates. So hopefully rates come in and take some of the pressure off. Wage growth is strong. If that continues to be the case, and it should, given the strong productivity growth, then with each passing month, we'll start to feel a little bit better about it. And the average American will start feeling, maybe never as good as I feel, but as an economist looking at these data, but, they'll be more consistent. Right now, there's a complete disconnect, and maybe it won't be, quite the disconnect that it is right now.
Well, I'm hoping that as many people as possible, whether they're economists or want to be economists or simply economist fanboys like myself, will listen to some of the things you're saying and at least the tone of what you're saying. Thank you so much, Mark, for joining me on the AFIRE podcast. Mark Zandi is, of course, the chief economist of Moody's Analytics and a good friend of AFIRE. Thank you so much, Mark.
Thank you, Gunnar. It's always a pleasure, and I really appreciate the opportunity to speak to the AFIRE and your podcast audience. Thank you.
You have been listening to the AFIRE podcast. Remember to subscribe on your favorite podcast subscription service, such as Apple, Spotify, Google, Stitchers, and others. AFIRE is not engaged in providing tax, accounting, or legal advice. No content in this podcast is to be construed as a recommendation to buy or sell any asset. Some information included has been obtained from third-party sources considered to be reliable, though AFIRE is not responsible for guaranteeing the accuracy of third-party information. The opinions expressed are those of its respective contributors and sources, and do not necessarily reflect those of AFIRE.